Welcome, future accountants. Today, we're going to break down one of the most powerful and honestly, one of the most misunderstood financial statements you'll ever work with, the Statement of Cash Flows, all guided by International Accounting Standard 7.
So, let's kick things off with a classic puzzle, a real head-scratcher that you absolutely need to get your mind around. How can a company be reporting millions in profit and still go bankrupt? I mean, how is that even possible? Well, the answer, as we're about to see, is all in the cash.
And we're going to solve that puzzle by building up your knowledge of this statement piece by piece. First, we'll cover why cash flow is such a big deal. Then we'll define all the key terms you need to know. After that, we'll jump into the three main pillars of activity, compare the two different ways to report them, and then wrap up with some of the trickier details.
Okay, so first things first. What's the whole point of this statement? Why do we even have it?
It really boils down to just one thing: tracking the real, actual movement of cash. You see, the income statement can be shaped by different accounting rules and estimates, but the cash flow statement, it tells you where the hard cash came from and where it went, no ambiguity. It is the absolute lifeblood of any business.
And when you use this statement alongside the others, it becomes an incredibly powerful tool. It lets you get a real handle on a company's financial structure. We're talking about things like liquidity, can it pay its bills next month? And solvency, its ability to survive long term. It really shows you if a company can actually pay its debts, fund its day-to-day operations, and invest in its own future.
Okay, let's dive into the nitty-gritty. You absolutely have to know these key terms. Think of them as the foundational building blocks for the entire statement, and they come straight from IAS 7.
First up, cash. And yep, this is pretty much exactly what it sounds like. We're talking about physical money, the cash in the register, and the money just sitting in the company's bank accounts ready to be used at a moment's notice. Simple as that.
Next, we've got cash equivalents. Now think of these as things that are almost cash. They're super safe, short-term investments that can be turned back into a known amount of cash really quickly. We're typically talking about a maturity of 3 months or less.
All right, now we get to our first big category of activities, operating. These are the core, day-to-day things a company does to bring in its main revenue. For a retailer, it's selling clothes. For a software company, it's selling subscriptions. It's the main reason the business exists.
Then you have investing activities. This is all about how a company is using its money to set itself up for the future. It involves buying and selling long-term assets, things like buildings, machinery, or even buying stakes in other companies, stuff that's going to help the business make more money down the road.
And finally, financing activities. This section tells you how the company gets its funding. It's all about tracking the money flowing between the company, its owners, and its lenders. So think about taking out a new loan, issuing more shares, or paying back debt.
Okay, so we've got the definitions down. Now let's make this stuff real. We're going to look at some concrete examples for each of those 3 pillars, so you can see exactly how cash moving in and out of a business gets classified.
Remember, this is the heart of the business. It's the engine room. Cash flow from operating activities is probably the most important indicator of a company's health. It tells you if the core business is actually generating enough cash to keep the lights on, or if it needs to borrow money just to survive.
And here are some perfect examples of those day-to-day cash movements. You've got cash coming in from your customers when they buy your stuff. And you've got cash going out to pay your suppliers, to pay your employees' salaries, and of course, to pay your taxes. Now, this next category is all about strategy. It shows you what a company is doing with its capital to grow over the long term. You can look at this section and ask, are they expanding? Are they buying new technology? Or maybe they're selling off old assets. This is where that story gets told.
So we're talking big ticket items here. This includes major cash payments to buy a new factory or a whole fleet of delivery trucks. But it also includes the cash that comes in when you eventually sell those assets. It's all about the buildup and breakdown of the company's productive base.
And our third pillar, financing, shows how the company is being funded by its owners and its creditors. It's the financial back and forth, showing how a business raises money to operate and grow, and also how it returns that money back to its investors.
And as you can see, all of these activities directly change the company's capital structure, its mix of debt and equity. So getting cash by issuing new stock, paying cash to buy back those shares, taking out a new bank loan, or paying off an old one, all of that stuff lives right here in financing. Now, here's a really important detail you need to know. For that operating activities section, and only for that section, IAS 7 actually gives companies a choice. They can present the information in one of two ways, what's called the direct method or the indirect method.
So on one hand, you've got the direct method. It's really straightforward. It just shows the major buckets of actual cash that came in and went out, like cash received from customers and cash paid to suppliers. On the other hand, you have the indirect method. This one starts with the net profit number from the income statement and then works backwards, making adjustments for all the non-cash items, like depreciation. Now here's the thing, IAS 7 actually encourages companies to use the direct method because it's clearer, but you're going to see the indirect method way more often in the real world. Why? Well, it's just a lot easier to pull together from the existing accounting records.
All right, let's wrap this up by covering a couple of the trickier parts and some important disclosure rules. This is the stuff that'll really round out your understanding of how this whole statement fits together.
Now, this is where it gets kind of interesting, because there's actually a bit of judgment involved. Take interest paid, for example. A company can classify that as either an operating or a financing activity, as long as they do it consistently year after year. And here's a crucial one. Big, significant transactions that didn't involve any cash at all, like, say, buying a building by giving the seller shares in your company, they are completely excluded from the statement itself, but you still have to disclose them somewhere else in the financial reports.
And in the end, it all comes back to this core idea, right from the standard itself. The whole purpose of this statement is to give you, the analyst, the investor, the manager, a clear, fact-based picture of a company's ability to generate cold, hard cash. And that is the ultimate measure of its short-term health and its flexibility to jump on new opportunities. So, I'll leave you with a final thought to chew on as you continue your studies. There's a famous saying in accounting that you'll hear a lot. Profit is an opinion, but cash is a fact. After everything we've just covered, which one do you think really tells you more about the true state of a business?